environment and the business strategy has changed and adapted over many years. And I think over the last 3 years, we've been closing the gap quite significantly on what we refer to as the ESG strategies that affect property ownership, property management, and property investment. Really, when we look at the E in our E vision, when we're looking at, and I'm a TAC property fund, we're a REIT listed on the Johannesburg Stock Exchange, mainly focused around Waterfall City. We basically look at hubs and we look at trying to develop hubs that basically look after sustainable full service offerings within the city. So it's not a single building. We try to look at strategies around providing the employee, the commuter, the retail shopper with a full encompassing experience of a live, work, and stay. But the main purpose around E and the way that it is modified design and is operations of building the E and ESG, or in other words, the environment, is that to be truly resilient and efficient and smart in the way we plan, design, and operate our portfolio, including our cities, infrastructure and buildings, both now and in the future. And then at the end of the day, year-on-year improvements in consumption performance against baseline through implementation of initiatives aimed at reducing the cost of occupation, carbon footprint, and achieving our reduction targets. Now, these reduction targets are something that we actually have to disclose on the JSE. We do that in terms of our integrated reports. That basically what it is doing is trying to reduce the reliance on fossil fuels and the environment, the impact, overall impact on the environment as a holistic element.
Then once again, coming back to, let me just get back to where I was, who has the right to renew the lease? So this is really important, especially where you have over-leased properties or under-leased properties. Where it's under-leased property, specifically when you're looking at a renewal that's in the hands of the leasee and not the lessor, and it stays on the same terms going forward, you would have to then look at the full lease and renewal periods. You might have a scenario as well where you've got an overlease and the lessor has the right to the terms of renewal at the same terms, and then you would also look at the full term of the lease, but obviously, and the renewal dates. But obviously, if it's a dual party decision, then one or the others must probably going to kick back at the renewal date. So you would only run to that first initial lease period. Okay, great. So basic rental identification, escalation, and turnover rentals. So it's important to check the term, obviously, like as we discussed, and what rental is payable in the current year. So going to have a look, I've just given some examples on the side here so you can check where the total rental comes in that specific year. And escalations, are they fixed or are they variable? So you have some that are based on CPI, some that are fixed. And then you often have, I know we saw one lately in the listed fund area where it was CPI up to 10%.
Yeah, I mean, basically, green building. If you look at where we're sitting, they are valued better and higher than best use type of scenarios in the market. So the problem becomes, how do you quantify the difference in the cap rates, or the DCF modeling structures as well? To what degree? And so in terms of maintenance expenses, obviously we've been running the portfolio for quite some time, that we do understand what these buildings do require in terms of maintenance. For Sean referred to the PV stuff. If you do the PV tenders, a lot of the stuff is based on kilowatt hour consumptions and how many times these things need to be replaced, that you actually build the capex into the model. With a DCF model, obviously it's very easy to factor that in over 25 years or 20-year useful life of the PV plants, and how you maintain them and when you need to replace transformers and how often you need to clean these sort of products. But at the end of the day, really what you're trying to get to the point is that these buildings do perform better, but what you do is you actually protect them from things like electrical price increases or the sensitivities of the macroeconomy on their physical operations. So you actually soften the effect of those macroeconomic impacts on the building and the performance of it over time. So the OPEX cost really kind of becomes a far more tangible number that really is what you're trying to protect them, because you will have lease renewals or lease negotiations or renewal cycles, but the biggest thing that you can't actually help is electrical price increases, water increases, and all of those wonderful stuff, because that doesn't ever revert back. All of a sudden, they're not going to say, well, it's a reversion period, we're going to drop electricity by 30%, as we would do on a reversion cycle on a lease that we would then re-sign over another 10 years. So that's really what you're trying to do with these green buildings, is to protect them against the elements that the tenants themselves cannot actually foresee, or even us as landlords cannot actually control. And then basically the green leasing stuff comes back to the structures of committing to these objectives moving forward. And that also includes CapEx over time. So what we do is we basically run a GCX model for the entire city. And the GCX model gives performance statistics across every building. So every building, every tenant has their own electrical consumption per square meter. What we do is we identify performance of those tenants relative to the benchmark, and then also we use, particularly in the retail portfolio. So we have tenants, for example, with very high turnover numbers that they have and low electrical consumption, but then we also have them with lower turnovers with high electrical consumption, which means they are far more sensitive to electrical price increases and sensitivities. And if they're good tenants that we've applied a lot of capex in for the TI numbers, and as Ishimi also referred to the difference between capex and TI. Sometimes with regards to the capex number is really your physical cost of building the building. The TI number is what we would put in over and above that to put a tenant into position so they'll be able to operate it. In terms of our actual physical leases, we split the costs separately. So what we do is sometimes give the tenants a loan at a base rate of, let's call it 9.25%, but then their actual rentals theoretically done on a basis where they actually amortize the loan over a period of time. That's where your top slice effect will do, because you don't want to be above market by the end effect of that lease coming to place. So that TI component, or the tenant installation allowance, is amortized over the 10-year period. That means your rental reversion at the end of that period is not actually as substantial. And that's really how we do it. And then in terms of the green leasing is actually performance matrix, where we put capex into the actual budgeting moving forward. So there is a valuation principle that every 3 years we then need to review. We need to put capex in, us as the landlord, and now the tenant, you can do it on a 50-50 basis, you can do it on a 70-30, or the tenant can pay for it all they want, all they need. There are, of course, things like IFRS and accounting standards tend to then play as to how they want to fund these sort of things, because you have your IFRS 16 requirements that you need to put your leasing obligations into it, but then you also have the amortization structures that exist on the accounting side, where you can amortize costs of borrowing over time, which actually means you gain in value as you start discounting those debt provisions. So you actually, while your business might be a little bit cash strapped at the start of the first year, it actually gets better and better over time as you start to amortize that debt. So a lot of those green provisions are built into those lease and performance matrices, and the variety of different structures as to how we kind of put them in depends on the tenant, their occupation, their lease covenants, how they choose how long they're there for. So, for example, a PwC signed for 12 years. Very easy to do an amortization, but if you're signing for 5 years to do an amortization, it almost becomes as much as the base rental. Yeah. So it doesn't really make sense for them to do that. So it really there's a number of different parameters depending on who we are dealing with over time as to how we will restructure those sort of things. But the toolkits do exist, they are in place, and they are being implemented. And in terms of ESG is driving that more into the basis, but it becomes a collaborative relationship with tenants. Yeah, as a landlord who understands how their tenants are operating over time means that they will stay in the building over time, and you basically put them into a best performance matrix over time to make sure that they actually make as much money as they possibly can. That's really what we're trying to achieve, because it's sustainable income flows to us.
So, and I think a thing that we specifically myself, I'm quite fortunate with, is that I deal with a lot of the listed funds and the different properties. So I see a lot of the 10-year DCF and versus 1-year income cap methodologies with this sort of solar top slice. And most of the valuations, we fall within sort of a 3 to 5% variance of those actual valuations, if they've done with the correct assumption. So like I said to you earlier on, the biggest thing to be aware of when you do a DCF and you're looking at 10-year with a value on reversion is that your assumptions are correct on rental growths and so on, because that can blow your value out on a 10-year DCF, which we do as well internally, and especially when they're long-term leases in place. And if you're making the incorrect assumptions over those periods on what the market's doing, you can have quite a blowout on those on the overall valuations. But there's not a massive discrepancy in the values on looking at it on either aspect, like Thomas is saying, with a sort of a capital structure that you're going to refurb those items further down the line in the provision versus doing the NPV of the term of that installation.
Yeah. Look, I think all in all, when I listen to all of this conversation, it actually touches on an important point that was mentioned earlier by Tom, in that as a valuer, you now need to understand the business aspect of a development and understand the benefit, because there could be an argument that fundamentally when you are valuing as a property, you ought to consider the property aspects, the real estate aspects of a property. I mean, when you talk real estate, you're talking about stuff that is fixed to the land and buildings, and that is not movable. But as we progress into this fourth industrial revolution, your smart cities, your ESG environment, a lot of what is not necessarily fixed in real estate and what is actually movable, so to speak, is actually having a direct and significant impact on the property and how the property is valued.